Hello, everybody. This is Chris Karam, Chief Investment Officer with Finspire, here to do a continuation of the Focus on the Market series, second quarter 2022, as we dive into sort of a mid to late quarter update, especially based on the heels of all the inflation and interest rate news and the impact that it's had on the markets over the last couple of weeks. I wanted to give you some perspective and some commentary about why we're here and where we're going. Again, this is meant to be a quick check-in, and we'll do a full-blown quarterly analysis in July as you're used to. But let's dive right in. Let's first look at the equity market performance of the S&P 500. Year to date, this was as of last week, was down 23%. The big news there is that the S&P 500 finally entered into bear market territory. Bear markets on average range from when you exceed or eclipse a 20% drawdown on the index. That's when it declares a bear market. And so we're in that zone now. And now we're actually in the process of trying to determine, how bad is it going to be from here? In the equity market, could we still have seen the worst of the worst as it relates to last week? We'll see, but I'll provide you not only with some perspective, but also some commentary in that regard as we look at a handful of these charts. Okay, first things first, let's put this in perspective. We have had a couple of years where we've had an extraordinary amount of unprecedented level of stimulus and relief and support and liquidity that's been injected to the markets, and now we're in that phase where we're withdrawing that liquidity in the form of higher interest rates and the Federal Reserve continuing to reduce its balance sheet looking forward. However, if we look at returns since the beginning of 2019, you can see this S&P 500 is still up 46% cumulatively. Since then, since the COVID peak of February of 2020, the S&P 500 is up 8%. And of course, since the beginning of the year, we're down 23%, which put us in that recent bear market territory. Well, the reason why that's important is that this was actually one of the shortest lived or one of the quickest bull markets on record. So from March of 2020 through the first part of this year is really where we ended this most recent bull market, switched over to bear territory, and you can see the bull and bear cycles over time, and this makes it one of the quickest bull markets that we've had, and we're hoping to get back to bull market territory. And if you back out COVID from that equation, we've really been in a bull run since March of 2009. So that bull, of course, lost its footing, gave it over to the bears recently here, and we'll see how quickly we can get back into bull market status. So what does that mean? So far this year, what has worked? Not much in the equity market, even not much in the fixed income world, with bonds, pressure on bonds. On interest rates moving higher, moved the bond market to minus 11% as an index in the first 5+ months of the year. Commodities, of course, were the winner. Commodities, a very broad basket, not just oil and gas, but livestock, agricultural products as well. Commodities have been the place to be. Typically, in these types of drawdown environments, you could argue that cash is a great place to be. The problem with that is that cash, yes, it had a return of just slightly above zero for the year, so far year to date. But really, after inflation is accounted for, whether you use 6% as a metric, 8% as a metric, seeing essentially a losing proposition in cash so far as well this year due to inflation makes for an unattractive place to be, especially now with yields where they are today in fixed income and the equity markets where they are from a valuation standpoint. When we look at those valuations, we see, yes, they're far lower than they were to start the year. The U.S. is probably right around average, maybe slightly above or below average, depending on the day, in terms of historical average valuation. Better valuation opportunities overseas in the developed and emerging markets, although some of the economic forecasts overseas aren't quite as relatively good as they are here in the U.S., even though we could be entering a recession here. And what triggers those recessions typically are interest rate increases. Well, this time around we had to raise interest rates due to the problem that we have with inflation. And so with the Federal Reserve making their statement last week that they increase short-term rates by 75 basis points, 0.75%, they are likely to do that again in the month of July at their July meetings. Academically speaking, short-term interest rates have to rise at or above the level of current levels of inflation in order to really stamp it out, which is what happened in the early 1980s when we had similar or higher levels or high levels, I should say, of inflation like we have today. And then you can see over time as the impact of those rising rates has on weakening the economy, that's when Fed policy tends to ease and monetary support starts to come back into the marketplace. Well, that's nice, but investors didn't wait for the Federal Reserve this time around. We've talked about this in previous videos. The 10-year yield on the U.S. Treasury yield went from 2.32% just at the end of March to 3.28% when this was printed on June 16th. That's a huge move in a very short period of time, put additional pressure on fixed income returns. That being said, entering at these higher interest rates could be very appealing for some investors as they look to generate yield and income from their investments. So there's always a lot baked into these yield curves. You can see the yield curve is actually more like a table. It's pretty flat, which tells us that economic weakness is ahead of us. And again, but that's not new news, right? That is not prophetic either, because that's was the likely outcome. The question is, can we avoid entering a significant recession? And leading into economic indicators, although deteriorating, don't tell us maybe the whole story, because there's a big transition from investing in goods or consumers buying goods to consumers experiencing services such as travel. We'll look at that in a moment. That being said, the leading economic indicators you can see are dropping off significantly here in the very recent set of months, and may continue to deteriorate as we look forward. But usually the equity markets are forward-looking out of that, and so the market is starting to price in a little bit of a recession, but we're not quite. It has not priced in probably a deep recession. But that's also maybe not the most likely scenario to occur. Why? Mortgage rates are high, but we haven't seen mortgage rates are significantly higher from where they were. They're closer or above 5%, in some cases getting closer to 6% on a 30-year mortgage. This is cooling off the housing market. We haven't yet seen it in prices, but that data is a little bit lagging, and there's still a shortage of supply, so you might see a better balance, if you will, or the real estate market to come into a better balance, especially when it comes to prices due to those higher interest rates, which can be challenging especially for those first-time home buyers and for second home purchasers who were eyeing maybe 30-year mortgages in the 3s and now looking at 5s. They might say, you know what, we may not need that investment after all. Of course, so that's starting to slow the housing market a little bit, which is something the Federal Reserve wants to see cool off a little bit, which will help with the inflation, will help control inflation, especially in housing, and we look out in the future. That being said, there's still a supply problem, so rents are rising. We'll get into that another time. But gas prices clearly are, along with interest rates, are the story of the summer so far. Gas prices are hitting multi-decade highs, and that is chewing up pocketbooks, investors' pocketbooks. And that's coming through in both the CPI figures and the core CPI figures. Now, the federal government releases these figures monthly. They say CPI, which is the Consumer Price Index, which includes food and energy, housing, other things go into the index of the Consumer Price Index. And that was the surprise of the market last week, where it rose to 8.6%. And so as a result, the Federal Reserve stepped in and raised rates 0.75% after initially signaling that they were going to raise 0.5% in order to get this inflation under control. Core CPI, however, ticked down a little bit, and core CPI down to 6%, and that's still a little bit way too high. However, there's some interesting things embedded in that core CPI report, including a significant reduction in inflation pressures on durable goods. So durable goods meaning things that last a long time, cars, autos, and appliances, for example. That rate of inflation started to come significantly lower, and that's a big deal, because if that starts to translate into PCE inflation figures, which is a metric of what people actually spend their money on, it's not an index, but an actual metric of what people spend their money on. This is the more closely watched metric of inflation by the Federal Reserve. Hopefully, we start to see core PCE come in further, although that may not happen with the recent input costs from a producer perspective, especially with energy costs going into the production of goods for consumption. The PCE figure is really important. That will be released next week, and we'll get our next reading on that, and to see how the Federal Reserve reacts to that data that comes in when they do their meetings in July. Put all this together: higher mortgage rates, higher gas prices, higher cost of food, and you've got this concoction that is quite toxic when it comes to consumer sentiment. Consumer sentiment and the expectations are the lowest they've been in over 40 years. But I will caution you on this. You might think, well, that makes sense. And it does, with all this bad news. And by the way, the war still happening, Russia and Ukraine. With all that soaked in, this is interesting historically. When consumer sentiment gets this level, that's usually the time when things in the equity market start to turn around. 2012, sentiment was very, very low. 2013 was a great year on the equity markets. 2009, sentiment was very, very low due to the great financial crisis, and more equity markets started to take off in March of 2009. Early 1990s, we went into a mild recession. People were getting very uneasy, and then equity markets took off. Early 1980s, we entered this double dip recession after Paul Volcker at the Federal Reserve decided to raise interest rates to a point that really stamped down inflation, only to grow much healthier in not just the economy, but also the equity markets have an extremely strong decade, and actually 2 decades afterwards. So be a little bit cautious when things are most negative. That's often, or most pessimistic is oftentimes when things start to turn around in the equity markets. Now, people have shifted how they spend their money from goods to services and experiences, and that came through in the TSA Checkpoint data. I can attest to this. I was moving through the airports earlier this month. It was packed, jam-packed with people. As a matter of fact, according to the TSA, more people passed through recently here as of June 16th when this data was collected than we had pre-COVID passing through the airport. So that is an indicator that people are still spending, but they're spending it on different things. Not surprisingly, with all of the increases in food and gas, things that we actually need to live, along with those experiences and services such as a vacation that maybe someone hasn't taken in a couple years, naturally it's putting a dent in the savings rate that was artificially high due to COVID stimulus and relief measures. And liquidity that was injected into the capital markets all found that way into everybody's individual pocketbooks. Much of that now has been spent down. We're going into a well below average savings rate at this point. But again, that's not too much of a surprise given the fact that we have all this pent-up demand, which is further, of course, pumping up inflation. Now, is this all bad? Not really. So when one thing I want to caution is that equities are still one of the best layers of defense to manage inflation risk. And because of that, that shows up in corporate earnings when people need to buy things, right? When you have inflation, things cost more. And although people may not consume the same maybe quantity, they're still paying higher prices, which ultimately fall into corporate coffers. And so what you see here is the earnings per S&P earnings in the blue mountain in the background, and the S&P index in the jagged line. Well, we're at that point now where in similar points in the past, like in 2020 and other points of time in this graph, where earnings are at a higher point than the movement of the index, and earnings ultimately drive the long-term return of the equity markets. And so with earnings holding up relatively well in the first quarter releases, we'll find out here in the month of July real soon, in a matter of a couple of weeks, whether or not those earnings hold. But the market is basically pricing in the fact that those earnings will deteriorate in the next quarter or two. Okay, so as we get the disclosures posted here, I just want to take a look forward at what we're contemplating here when we look into not just when we get into a full-blown analysis in July, but also take a look ahead at the economy and the markets for the rest of the year. We've got a couple of things that are happening. One, this inflation story is slow forming. We have to wait on month to month type data in order to get confirmation and validation that we're seeing inflation start to control itself with these higher interest rates and perhaps higher prices, being people afraid to pay high prices for things, which is controlling and stymieing demand essentially for certain goods and services, which in effect is deflationary. We're also going to take a look at politics. Okay, so this is a political year, midterm elections coming up in November 2022, and we're going to get a readout as to what the makeup of Congress relative to the White House is, and we'll show you some interesting charts there of what's been the most successful combination of, historically speaking, of control of Congress versus control of the White House. It may surprise you when you see that. But our bottom line here from an investment standpoint is to remain very, very well diversified. We're as well diversified as we ever have been into areas, whether it's in the commodities markets, in the metals and mining space, into areas that are more flexible in terms of asset allocation. And we're also, this market, because it's slow forming with the return of inflation back down to lower levels, which is going to take time, we're going to have to remain patient. Knowing that cash is probably not the best alternative in this environment, where after inflation you might be losing 6 to 8%. So that's going to require patience on all levels if you're a conservative investor tilted towards fixed income, or if you're a more aggressive investor tilted towards the results of the equity market. Patience is the key. But we'll have another update for you coming up here in July. With that, it's a quick check-in. I'm Chris Karam, Chief Investment Officer with Finspire, and we'll talk to you real soon.